Okay, so we can start our class now. Good morning, everyone. Kindly confirm, I need just one person to confirm that you can hear me clearly before I proceed with the class. Anyone?
We can hear
Yeah,
you.
can you? Good morning.
All right, good morning. Okay, so this is a combined class. Our virtual class students and a VI and some other people that are joining us, probably for the first time, our former students. And we're going to start a 7 weeks journey towards ensuring that you pass your case study exam. And what we want to look at today is to start what we need to know almost immediately. So let's get to it. I'll be sharing this material with you in due course. And it will be continually updated as we move on. So what we want to achieve at the end of this class is basically to ensure that everyone that participates in this 7 weeks intensive case study class has the ability and to get at least 60 over 100, at least minimum in the exam. That's the focus. And the approach we use for case study is quite different from other courses because case study is different from other courses. Case study is not what we want to be teaching you week in, week out, like we do for other courses. No, that would be a wrong approach, which is why we waited till like maybe 2 months to your exam before we decided to commence the case study class. Now, the first thing I need you to have at the back of your mind for case study exam is that we are seeing you are going to be in a position of a business advisor. Like you want to provide advisory service to a client. So in most of your question, you are going to be like a consultant. You are going to be like a business advisor, and there would be a client that wants series of advice. And this advice is going to be in the form of a written report. So basically, what I want to teach you during this period of case study that we have is your ability to provide advisory services. So, and is this and a very important part of it is your ability to write reports where you can present your findings and recommendation, and you can present it very clearly to the examiner. Basically, that's the first thing I need you to have at the back of your mind. That case study is about you having the skill to provide advisory services. So when we say provision of advisory services, what is it about? What are you going to be doing? What type of service is that? Yes, you want to provide advice, fine. But 5 major things we will cover. 5 major things or areas you need to know. Number one is before you can provide advisory service, you have to first carry out an analysis of the data that you have at hand. Data's like financial statements of the company, data's like maybe ratios, maybe you will be computing this yourself, data's like budgets, data's like cash flow information, data's so a lot of data about maybe the market environment in which the company operates, the industry in which the organization operates. In fact, you would learn later as we move on that they will definitely give us prescene. Of course, we will have spent a lot of time looking at series of prescene in this class and the unseen. So that prescene, when we look at it, you see that all they are giving us is data. All they are giving you is data. Data about the company, data about the industry, data about the macroeconomic environment, the country, the global environment, data. So the first skill we would have in this class is how to analyze those data. In fact, that's majorly part of what we're going to focus on today, analysis. You have to be very good at that. That's almost 60%, 60% of what you require to pass. So it's a major thing. Now, when you do your analysis, you identify a lot of gaps within the entity. You will see it clearly. When you analyze, you will see gaps. You will see risk. You will see opportunity. You will see it clearly, and you will see how it affects the company. And that is the gap we want to fill. That's evaluation. So evaluation is seeing what they cannot see from your own analysis. You evaluate. And there's no way you can evaluate, you can see anything without some multidisciplinary skills like knowledge of finance, reporting, tax, and audit environment. You will be applying a lot of this knowledge subtly, it should be general knowledge that we need to know. By the time we review series of prescene and unseen, you will get used to those applications. You'll see that there are subtle applications here and there, and we will have actually touched on those areas. The most important parts, which almost takes like, before you can get that 60% in analysis, you need to be able to communicate through report writing. So we're going to look at, we won't be able to look at reports today, but next week, before we start writing reports from upper week, we're going to look at report writing, because that's how you can communicate your findings, your recommendations to the user, wherever the person is. And of course, because you are going to be identifying gaps from the data they have given to you, you have to make your recommendations on solid ethical foundation, on solid ethical reasoning. You need to be cautious of the recommendation you give to your clients. You need to be cautious of the data they use and the use of those data, that they are ethical. You have to find a way to bring in ethics into your report, into your evaluation, into your recommendation. Ethics is extremely important, and it takes like almost 10%. So a lot of students will lose mark without saying anything around conflict of interest, without saying anything around business ethics, without saying anything around any commercial pressure that the company is facing. When a company is running losses, or when a company has promised a very high level of performance to investors, you need to identify some ethical issues there. Don't leave the exam for a case study exam without mentioning ethical issues and how to ensure the safeguard against them. Ethics is important in case study exam. Now, all of these are what we want to focus on during the course of our 14 hours class. And all of these makes you or creates the skill for you to provide advisory services. So these I've just mentioned within a few minutes. I need you to resonate with it. I need you to have it at the back of your mind that what you're going into that exam to do is you want to go and provide advisory service, and it's not just for your exam. Something is a skill you also need as a chartered accountant. This course is not a course where you want to come and memorize. No, we're not memorizing anything. All the analysis we do, it's more of application of knowledge and judgment. Application of knowledge and judgment. Nobody would memorize anything. As you will see the approach we're going to use. So, two things is therefore clear from what I've mentioned so far. Two things is clear. Number one is analytical skills. Analytical skills. So I'll spend a lot of time on that today. I can't even finish it. After analytical skills, number two is report writing skills. Report writing. So it's report writing that a lot of ethics, communication, and all of that will come into play. So those are the two things that you're going to that exam to learn. You're going to that exam to display analytical skills and report writing skills. Now, let's start with the analytical skills. Basically, generally, is three areas, but I just add some things to it because number one, before you can analyze anything, you need to understand the data. Like I mentioned to you, you will be given data. And good enough, they give you those data before the exam. So it won't be a problem for us. As soon as we get those data, which is what they call present, we're going to do a lot. We're going to tear it down. We're going to analyze it. We're going to assimilate it first. Then we would go ahead with analysis, evaluation of it. That in the exam, none of you will have the same answer because it now depends on how you're able to get the message you are going to pass across. That will determine what you're going to be communicating to the examiner. Of course, I'm going to take you through the marking guide so that you are very careful when you're writing that you are within what the examiner wants and you're picking your point as you move on. So when you assimilate and understand the data, then you start your analysis. So today, basically, I'll be looking at financial statement analysis. You need to be able to paint a story for the company. You need to be able to understand where the company is going. And from the information you have on their financials, you need to be able to see where they might be in the future. Aside from financial statement analysis, there are some other data that you'll be given. You need to be able to analyze those as well, which is financial data analysis. Most likely, you are going to be looking at this next week, where we are going to be looking at issues around contribution margin analysis, variance analysis, budget, valuation, capital restructuring. All of those are financial data. It's different from financial statement analysis. Financial statement focuses on the financial statement as you know it. Analyze those ones. But other data, other financial data you have, you need to be able to analyze it as well. And also is business analysis. You need to be able to analyze the environment. You need to be able to analyze the industry. You need to be able to analyze the value chain of the company. I know Mr. Ali has taken some of you through this, but I'm still going to summarize it for you, focusing on the ones you will always use in the exam, like Pestel, like Portas, FIFOS, and all that. So I know you need to focus on the model you're going to use to analyze the environment, the business, the macroeconomic environment. You're going to use it to analyze the industry in which the company operates, the internal analysis of the company, including its value chain. Like I mentioned, these three is like 60% of the marks you can get. So with this analysis, you would have almost passed your exam. Then the report will just follow through with it. And last one is understanding the industry and the business and ethical consideration. Like you know already, because I've mentioned it severally, they are going to give us data, which is pre-seen information, and they are going to give us unseen. And unseen is, you'll be familiar with it because by the time I show you series of past questions, you see that the unseen are almost the same year in, diet out. So we would have gotten yourself ready with a lot of tools that you're going to have analyzed the data with. And when you get to the exam, you should be able to, the unseen should not shock you. It should not. So, of course, this exam is going to be 4 hours, and they're broken it down into a lot of sections. So, we're going to talk more on this when we start applying all these analytical skills we will have created in the next 2 classes. Then we'll start displaying those past questions to us. Now, basically today, the focus is going to be on financial statement analysis, which is like 20% of what you are required to know for this exam. Like I mentioned, what you want to analyze are basically the financial statements of the company, which includes statement of financial position, statement of profit or loss, statement of cash flow, changes in equity, and notes, depending on the level of information the examiner is ready to give to you. So you would need to be able to gain insights into those data so that you can help users, whoever you are writing the report to make informed decision. So basically, 4 tools we are going to look at, 4 analytical tools. One is horizontal analysis, which is also called trend analysis. Another one is vertical analysis, which is also called common size analysis. And then we're going to look at ratio analysis and also cash flow analysis. I'm not saying that you might not necessarily apply all these in the exam. We'll find a way to balance all when we start looking at your past questions, but you need to have good knowledge of all of this. At the end of the day, we will know when to apply which at every point in time, depending on the data given to us in the exam. That will determine the route we want to follow. Eventually, you will understand that. Now, the first one, which is horizontal analysis or trend analysis. So basically, this involves comparing year to year, looking at year 1 and year 2, or year 3 and year 3, and year 4, and using it to make informed decision. And when you look at horizontal analysis, you're going to, of course, see changes in revenue, expense, asset, and liabilities of the company. You are going to understand growth patterns, where they are exposed to risk, and where they are sustaining their performance or other sustainability related issues. And you're going to see and be able to link those changes to strategic implementation or how it might affect them in the future. Now, when we are looking at comparing one year and another, which is horizontal analysis or trend analysis, in order to see patterns, in order to understand risk or even opportunity as it were, we are going to express those changes either in percentage or in absolute terms. If you're expressing it in percentage, it's just doing your current year minus the previous year divided by the previous year. That will give you the percentage change. And absolute is just comparing the current and the previous. Now, if you look at this extract of income statement, for example, now, they gave us revenue, cost of sales, gross profit, operating analysis, operating expense, finance cost, and PBT. If you want to carry out a trend analysis here, all we just want to look at is to look at the changes between year 1 and 2. And here, in order to carry out this analysis, I will show you both, you want to do it absolutely and in percentage. If you want to do it absolutely, the change now, 24 minus 20. So that means there is a change of 4,000. Let me show you. I think I have it here. Yes. If you look at this, in absolute terms, there is revenue increased by 4. And in percentage terms, revenue increased by 20%. So, can anyone confirm how they got this 20%? Or is there anyone here that does not know how this 20% was arrived at? Everybody understands it. So it's simply 4,000 minus the base of 20,000. That's percentage change. 4,000 minus the base. And that's how every other one also was arrived at. The cost of sales, the gross profits, operating expenses, finance costs, PBT. Now, when you do this, you will get little or no mark with just this. What gives you mark is your analysis. What gives you mark is your insights into this data. Yes, you have done an horizontal analysis, but you need to be able to understand what is happening. You need to be able to understand what is happening. Okay, hold on. I think somebody said you can't get that.
So, please can you send the material to the group?
Yes, I will do that after the class.
Okay.
Yeah. So somebody said they can't get this 20%. So let's show her. So can we do 4,000 divided by 20,000? What does it give us?
1/5.
Okay. So does that translate to 20%?
Yes, sir.
Okay. So that's how we got it. And that's how they got every other one too. The percentage change. As I was saying, yes, you have done the horizontal analysis, but you need to be able to understand what is happening with this data. So if I want to speak to this data, I will tell you that the company's revenue has increased by 20% year on year, but the increase in costs, indirect costs, outpaced the increase in revenue, resulting in tightening or in a reduction in gross profit, resulting in a reduction in maybe your GPM, your gross profit margin. Additionally, operating expenses increased by 50%, majorly because there's an increase in overheads like marketing costs and other administrative expenses to run the affairs of the business. And also, the company finance costs has increased by 50%, showing that the company is relying heavily on debt to finance operations. And this has resulted in a declining profit before tax. So following from this, the company is exposed to financial risk, and the company needs to improve its revenue and engage in cost reduction strategy in order to improve its profits and also liquidity so as to reduce leverage or use of debt in financing operations. Now, the analysis is here that I just gave you. I have it in the note I'm going to share with you. But I don't want you to cram. I need you to be able to relate with it. Speak to the data. Speak to your workings. You will see here that it's clear. The analysis I just gave you, or the commentary or the interpretation I just gave you, is not it's very scientific, it's logical, because the data are clear. I can see that revenue grew by 20%. And I can see that cost of sales rose faster than growth in revenue. And definitely to compress your gross margin, gross profit, because if cost of sales was not growing faster now, his gross profit margin or his gross profit will have been better in 2024 than what he's having right now. So it's going to compress gross profit margin. And when I confirmed it, I saw that gross profit margin in 2023 was 8,000 over 20,000, which is 40%. But in 2024, it decreased to 35%, which is 8,004 divided by 24,000. It decreased. And that's because the cost of sales is rising faster. And operating expenses increased disproportionately by 50%, probably due to maybe the company is expanding, inflation, inefficiencies, and all that. Finance costs rose 50%, suggesting increased borrowings. And our PBT fell by 40%, indicating that revenue growth, even though revenue grew by 20%, but it did not translate into profits because of the cost structure that it has, because of the increase in cost that's outpacing the revenue. So in your exam, you'll probably be concluding that though revenue sales increased, that's in your conclusion. All of this later, when we start writing reports, you'll see that this is what we'll be writing in our report. By the time you will have done this in your appendix, in the body of your reports, these are what we'll be writing there. So it's just we're just starting. So those sales increased, but profitability declined due to rising costs and higher leverage. So the company's cost structure needs review. Okay, I can take questions now.
Okay, sir. Sorry, I wanted to ask. In this case, we can observe that gross profit increased by 5%, but like you said, the compared the gross profit margin of last year um was higher than the one for this year. So does that mean like because I was like the showing here that the gross profit here is increasing while here is showing gross profit margin is reducing. So are they trying to say that like the profits would have grown faster if they maintained their gross profit margin of last year or something like that? I just wanted to clarify.
Yes, yes. So what we are saying here is that their cost is too high. Yes, the absolute amount of gross profit went up. It went up. But from our analysis, I mean, this is just raw data. But by the time we looked at it deeper, which is what you as a business advisor, by the time we look at it deeply, we saw that these guys will have done better now. Because yes, your revenue grew by 20%, but look at your cost, it's growing by 30%. So if you can manage this, if this is going by less than that, that means you will have done better in terms of gross profit margin, in terms of your gross margin. Probably it will be growing at a much higher rate than just this 5%. And this faster growth in cost of sales resulted in a declining gross profit margin. It declined from 40% to 35%. It declined. So they might be, you as a business, you that you're providing advisory service to them, they might be celebrating increase in gross profit. You will tell them, no, don't. Your costs, your increase in cost is higher than your growth in revenue. It should not be. It should not be. And additionally, the operating expenses is even increasing disproportionately. It's disproportionate in the sense that it's increasing by double, by almost not double, 50%. That's a lot. Yes, we don't have the full details. Probably maybe they are expanding and they are doing a lot of adverts. Or it could be inflation. It's possible. And it can be inefficiencies. Some people might just sit down and be increasing their salaries or spending money on entertainment or doing PR. In the exam, they will give you those data. So you will be able to link the numbers to the data. You have to speak to the data. Because in the exam, you will know why. So when we start applying all these to the exam, you enjoy it better because we'll have the full picture. And this is all we will write in the body of our report. We need to raise all of these. You express yourself. You tell them what is happening. You're a business, you are advising them. You sit down in the exam as a business advisor. You advise them. This is what I'm saying. And this company is highly leveraged. 50% increase in finance costs. They have to be careful. That's financial risk. And look at their PBT. It's falling by 40%. So growth in revenue, 20%. Profit is falling by 40%. This company is in trouble. They need to do something very fast. That is where recommendations and conclusion comes in. It's key. You have to be, those parts has to be very clear after you have done your interpretation, right? You see, your conclusion and your recommendation must be clear. You need to speak to them directly. See that from all of this, yes, your sales has increased, but your profits is declining because your cost is getting too much. You guys are borrowing too much. And you tell them this is what you should do. Review your cost structure, reduce your cost. Then you move on to another item like that. Okay, I would like to take more comments from you. Opelo, you want to say something?
Yes, sir. Good morning, sir. Good morning, everybody. As per the gross profit, can you hear me, sir?
Yes, I can hear you,
Can you
please.
hear me? Okay, as
Yes,
per the gross profit that you just mentioned, gross profit in year 2023 is 40%, and the one in year 2024 is 35%. By virtue of that, I'm just thinking that the gross profit is reducing and not increasing. It's reducing, and this percentage change is supposed to be negative 5%, not positive 5%. That's my observation.
okay. So you're mixing up gross profit margin with the absolute amount of gross profit. So the gross profit in 2023 is 8,000. The gross profit in 2024 is 8,400. There's an absolute increase in gross profit of 400. There is a percentage increase in gross profit of 5%, which is 400 divided by 8,000. So
Okay,
that's, yes.
okay, that one is just a percentage change. Okay,
Yes,
okay.
yes, yes. So
But in
this one,
recent,
yes,
the actual gross profit margin is decreased by 5%, right?
that's correct. That's correct.
Okay, thank you, sir. That's what I just want to know. Thank you,
Yes.
sir. Let's
You're
go.
welcome. Can I take other comments? Is there any other thing anyone can see here from this data that we have not spoken to? Okay, so the data can come in variety of ways, so you have to be prepared and be able to speak to it in using horizontal analysis. Now, what if what the data they gave you is statement of financial position? So they gave you total assets, current assets, total liabilities, equity. And from here, I can see that my total asset increased by 6,000. I can see that my current asset increased by 2,000. I can see that my liabilities increased by 6,000, but my equity did not change. Who can interpret, conclude, and make recommendations on this data from this horizontal analysis that we just did? Can you just try? Interpret, conclude, and make recommendations to them.
Hello, sir.
Yes, sir, Mr. Jebede, I'm with you.
Sorry, I want to quickly ask question concerning the finance costs that we discussed on the first analysis.
Okay, let me go back there. Go ahead, please.
Yeah, we said the finance cost increased by 50%. Is it caused by increase in borrowing or the general increase in finance cost itself? Because I'm
Okay.
seeing that it increase is suggesting increase in borrowings. So I'm thinking is increase in general finance costs. Because I want you to throw more light on that.
Okay, no problem. You know that finance cost means interest payment. I mean, If you don't want to go deep into financial reporting, it can mean otherwise as well. Anyways, it could be lease interest and all that. But finance costs is primarily interest that you pay on your borrowing. So when you see finance costs increasing, you accept the data states otherwise that they will give you in the exam. Assume that it's because of borrowing. So no other reason. Primarily it's because your borrowing is going up. Except the data tells you something like maybe your existing borrowing, the banker or the lender increased the rate of interest. Except that, then you can be speaking to that as well. Then you can be advising them on how to go to them, reduce the interest and all of that. But here now, we don't have those data. What I can see here is that their interest is increasing. It's primarily because you are borrowing more. You are borrowing more. So you are free and conveniently conclude that in the exam. You don't have any problem.
Okay, sir.
Now, let's come back to this. Is there anyone here that can speak to this data, interpret, conclude, and recommend? Can anyone give it a shot?
Hello,
Mm,
sir.
Okay.
okay.
Hello, sir.
Hello. Yeah, hello, I'm with you. Yeah, I can hear you, Salami. Are we speaking?
Okay, can I try?
Yes, please.
Okay, I wanted what I understood was that, like, as seen here, total assets grew by 6 million, and so the total liabilities. So what I want to, or what I feel I can deduce is that the company is taking on more debt to finance projects or to finance certain assets. So that means the company is trying to expand or to grow in its operations. So that's why liabilities and assets are increasing. Then I also saw that current assets are increasing. This may be due to increase in the stock being produced as a result of the increase in the assets that the company has attained, or this may be due to more cash in hand, of which, okay, I don't think it should be increasing more cash in. Okay, yes, increasing more cash in hand due to, like, maybe they collected liabilities, so they have like more cash at hand to fund their certain projects and things like that. So that's what me I understand. Because there was no increase in equity to finance those the growth in the assets. So that's what I deduce.
So is there any recommendations for them?
Um I recommend that the company, although it's good that the company is growing in their operations, they should try and they should currently try and see what they can do to remove excess cash if there's any, so that there won't be any idle cash at hand. So they can try and invest any excess fund that is not in use. Any excess fund they got from the borrowings, they should invest it until when they want to use it. Then I also recommend that um they should try and control any further increase in liabilities so that their gearing will not be too much, which would cause is it insolvency? Yes. So that yeah, which could cause insolvency. So they should watch out or control their gearing. So that's what I recommend.
Okay, makes sense. Makes sense. You have spoken well, and it's not a record science. It's very clear, as you have mentioned. So Major issues here is look at the liabilities increasing by 33%. And the assets only increased by 20%. Even though, yes, the current assets increased by 20%, but I'm going to speak for the total assets, because these current assets is included in the total assets. So that means, like he has mentioned, why are you getting so much liability and you cannot increase almost by much more? Because when you get liability and it increased by 33%, let's see it translate to increase in underlying assets. And even the underlying assets, it should not fully be funded by just liabilities. It should be funded by even equity as well. Otherwise, it means you are highly financially leveraged, which exposes the company to financial risk. So they're having just equity of, if our equity did not change, 0%. So this company needs to find a way to reduce their leverage. They need to invest and reinvest in increasing their assets so that they would have cash flows to pay the interest and principal payments to these liabilities. And if they need more money, they need to find a way to raise more money through equity. They should not further raise money through liabilities anymore, like that. And that's speaking to those numbers. So as we can see, this company, asset increased by 20%, debt by 33%, but equity remains very stagnant. This is a signal of financial risk and declining solvency strength, because they will not have money. They will not have money to pay dividend. All they'll be paying is interest. Interest, interest, interest. So the company is growing through leverage, which may not be sustainable if their profit keeps falling. They could run out of business. Those ones can shut them down. So like I've mentioned, when it comes to horizontal analysis, it's not just the calculation. Calculation will sit in your appendix. Yes, you get marks for that. But it's your interpretation, your conclusion, your recommendation that gives you, that's where the juice is. All your calculation in your appendix, you get marks for that, fine. But more marks comes from when you're speaking to your calculations, when you're highlighting the positives, when you're highlighting the negatives, when you're giving implication, linking numbers to strategy, linking numbers to risk, linking numbers to decisions. And I would advise that you always present a table of changes, both in absolute and in percentage. It makes you flexible in terms of your analysis. It makes you see the numbers clearly under horizontal analysis. So that's it for horizontal analysis. We are going to come back to it when we start solving past
Hello,
options.
sir.
Yeah,
Hello, sir.
Yes,
Yeah, well done, sir. Please, before we proceed further, I want to ask a question at that area of income statement. Then I wanted to ask the question, but my network was just streaming out.
Okay, sorry.
Okay. Now, we are looking at profit, PBT, that is profit before tax. The
Yes.
changes give us negative 1.1640%. So I want to ask a question. Is it as a result of increase in finance costs that threw their profit to negative? Because we can see that they have better gross profits, they still have something to sew up. But when it gets to net profit, there's nothing again. I don't know if you understand my statement.
Oh, very well, I do. So, like we mentioned earlier, you need to be able to speak around all of this. And when you look at it, this reduction in PBT by 40% is as a result of disproportionate increase in cost of sales.
Okay.
Cost of sales increased by 30% and revenue just increased by 20%.
Okay.
Additionally, your operating expenses, look at it, it increased by 50%.
That is high. Yeah.
50. So your revenue just increased by 20. So cost of sales already increased by 20%. This one increased by 50.
Yes, there's nothing to sort it.
Exactly. Finance cost itself by 50%. So
Now
it
carry his
can
own body
result.
come.
Yes. So increase in revenue is not translating to increase in profit because of their cost structure. Their cost is too much. They want
Yes,
you to talk.
50%. Above
Yeah.
30 and 20. Yeah. Thank you, sir. I understand.
All
God
right.
bless you.
So, like I've mentioned, when you use horizontal analysis, you have to do this absolute and percentage change. It gives you one is that you will not make mistake when you're computing this percentage change because it will just be the change over the
In
base.
fact, it made the interpretation to be very clear.
Exactly.
Good.
Okay.
Thank for the format.
You're welcome. Now, I guess we can move to vertical analysis, which we also call common size analysis. So this one, you analyze your financials by having an item that you are comparing all the other items with. So you are looking at having a base figure. And the common one we have for income statement or statement of profit or loss is usually revenue. We will see revenue as the standard, as a base figure. We will now compare every other item as a proportion of that base figure. All you're doing is common size analysis or vertical analysis. So you're having a base figure, a standard. You are not comparing every other item as a percentage or as a proportion of that. The same thing with balance sheets, your statement of financial position. You are comparing your other item as a percentage of your total assets. That's usually the common one you find us using as a base figure. So this one, it can easily spot which item is putting pressure on our bottom line, which item is putting pressure on our capital structure, which item is putting pressure on our liquidity. And it's easy to then have an industry-wide comparison using vertical analysis because you can compare that company A only did 4% of their revenue as salaries, but we are doing 20% of our revenue as salaries. So it's so easy to speak, to do industry comparison, to do benchmarking against industry average. It's so easy. And you can easily spot red flags when you do vertical analysis, you would easily, because you will see that, okay, I'm comparing against a base figure. So you will see the one that is shooting out. This one is too high now. You will see it standing there. That this is the red flag. So it clearly shows the pain areas. It clearly shows the areas of pressure where you have liquidity issue, where you have cost structure issue, where you have capital structural issue. It will show it clearly. And it's just that item divided by that base figure times 100. It gives you your vertical analysis. So looking at this, they gave us income statement, revenue to PBT, and doing vertical analysis using revenue as a base figure. So I'm calculating other item as a percentage of my revenue. So in 2023, my cost of sales is 65% of my revenue. In 2024, it's 70%. So it increased by 5 points or 5%. My gross profit is 35% of my revenue. In 2024, it decreased to 30%. So there's a reduction by 5%. My operating expenses is 15%. I hope that you understand that the calculation is 15 over 10,000. It's just the item over 1423. And my finance cost is 5% and approximately 5% also. So there was no change in finance cost. And PBT 15% and 5%. So this decreased by 10. So you see, looking at it, you will see that the pain point here, the pressure point is your cost of sales here. It's clear because it's shooting out, it's shouting 65% to 70%. The cost of sales is the problem. Find a way to reduce it. Every other one is subtle. Yeah, operating expenses is also high. So in your exam, they might have given you industry average. They must have given you your budget, your plan, and all of that. Then you would be able to do it. Okay, yeah, somebody is asking, how did we get this? So the cost of this 65% is 6,005 over 10,000. Okay, this 65%. This 70% is 8,004 over 12,000. You know that in the exam, you don't have to be doing all those, this is what you give them in the exam. This, because at your level now, you won't be wasting too much time on appendices. So you just press your calculator to get these figures that you need. Why this 35% is this 35 over 10,000. And in 2024, this 36 over 12,000. My operating expenses, this is 15 over 10,000, like that. I hope you understand it now. And I speak to the movement year on year as well,
Hello, sir.
increasing, decreasing, and all that. Yes, I'm with
Hello,
you.
sir.
Yes.
Sorry, sir. I'm just trying to ask. I just want to. I'm asking for clarification. I was thinking that this analysis that you're doing here is going to be done in the. Oh no, this calculation of this percentage is going to be done on the. What side? Not on the where you make your actual reports. It's going to be done
Yeah.
at the appendix. I was thinking that is the analysis itself that you're going to make use of when you are not using this particular computation in your analysis, but rather it's going to be at the appendix side. So I don't know.
Yes, you are correct now. This one, should be what you're saying is that this one will do it to show in our appendix, right?
Yes, sir. That's what I'm saying.
Yes, now that's where to show.
Okay,
That's
okay,
where
sir.
to show. So is in your report to then do all your analysis and all that. That you
Okay,
speak
sir.
to data. Yeah.
Okay, thank you.
Yes. I mean, when we start solving those past questions, I will do the actual report for you. So exactly what you would do in the exam, we'll do it before the exam. So we won't just be talking. We'll do it live. So but we need to set like a foundation, a very strong foundation, and that's what we're going to use the first 2 weeks to do. Then from the remaining 4 weeks is just doing the actual things like that. Yes. So like I mentioned, you see this is where the problem is. This is the pressure point for this company. Their cost of sales is extremely, is disproportionately is high as a percentage of any other, as a percentage of your revenue. So, and that would depress your gross profits margin. It's going to depress your profits. And look at them, their profit is decreasing by 10%. It's majorly because of this huge, humongous cost of sales. So this one, you will see where the problem is. Clearly, you see it there. So from here now, although sales grew, but profitability weakened due to higher cost of sales and operating expenses. Unless cost controls are implemented, future growth may not translate into shareholders' value. So, and before I came to this conclusion, I did my analysis that my cost of goods sold increased from 65% to 70% of sales, compressing gross profit margin. This suggests rising input costs or weak pricing power. My operating expenses rose from 15% to 20%, indicating higher overheads or inefficiency. Finance costs remain constant at 5%, meaning debt burden did not change, and PBT dropped sharply from 15%, showing profitability erosion. Then I concluded telling them that sales did not translate into profitability because of cost of sales and operating expenses, and I made recommendations that they need to implement cost controls. Otherwise, future growth will not translate into shareholders' value because of declining profits. Because your anytime you are making losses, your profit is declining, it's going to be eaten through your capital. That's what declining profit does to any entity. Now, for the balance sheets, here we are going to use the total assets as a base figure. So if you do 8,000 divided by 20, that gives me 20% or 40%. If you do 9,000 divided by 25,000, that gives me 36%. If you do non-current assets, 12,000 divided by 20, that's 60%. If you do 16,000 divided by 64, no, 16,000 divided by 25, that's 64%. 6,000 divided by 20, current liabilities 30. 75 divided by 25, 30%. And my non-current liabilities also 20, 30. Equity 50%, 40%. So here now, I can see that the major highlight is my non-current assets as a percentage of my total. So I have major non-current assets. So showing that this company is heavily invested in capital expenditures. And yeah, I can see that this company is not so leveraged. Not that they are not leveraged, but not so leveraged, because their equity is more participating. Is more participating because higher, much higher than their non-current liabilities. So This company is stable to a large extent because they are financing their assets majorly from equity. Not saying that their liability is not there, because now it's getting to be is increasing. Is increasing. If this increase continue, it might match up against the increase in equity eventually. So they need to watch that. And we need to see that this increase in capital expenditure was actually budgeted for, and also is translating into revenue and profit. Otherwise, you might have to increase in relevant capital expenditure, or probably or maybe probably increase efficiency with which they operate those assets. So from here now, we can see that yes, non-current assets is the main point there. So equity funding declined. In fact, it declined. Equity is declining, while debt is increasing. So they are becoming more leveraged. So because this is declining, this is increasing. So the company is then getting more debt dependent, and might have affect the money they would have to pay dividend if they have to be funding interest. So they need to do something about it by ensuring that this increase in capex or capital expenditure. When I say capex, I mean capital expenditure. So translates into revenue. We need to see that at the end of the day. So that's vertical analysis or common size analysis.
Hello, sir. Sorry, sir.
Yeah.
So I have a question.
Yes,
This
please.
this vertical, we talk about this vertical. For example, now I'm going to maybe too many steps ahead of myself. Like in exam situation, if a profit income statement is given, or the balance sheet, which is profit the balance sheet is given, is it a standard that we're going to use, like on the P&L, we're going to use the revenue, and on the balance sheet we're using the total asset? Is that a standard that's going to be asked the question, or that's how it's supposed to be by norm? Once we are told to use vertical, it's going to be that you are using the base as the revenue, and you're using the other base for the balance sheet as the total asset. Or they can maybe frame the question whereby you use something else as your base.
Okay, Anthony, I think I get your question, but I can't hear you again. I think your line is breaking, but I think I get your point.
But can you hear me
get
now?
the point you're
Let me just
making.
emphasize. If you, I don't know. Okay.
So Anthony is asking that, yes. So Anthony is asking that, is it a standard that when we are doing common size analysis or vertical analysis, that we do it as a percentage of total assets, every other item as a percentage of total assets, and also the income statement item as a percentage of revenue? So I would say yes is a standard. But that does not mean you cannot do it as a percentage of other items, but I would strongly advise that you do that, because you can easily relate every other items to the top line, to revenue, because the revenue that is birthing those other items in income statement, for example. So, and it's easy for you to interpret. Not saying that in real life you cannot have another base, but we popularly, in fact, in real life, when I want to do this for my clients, I use revenue and total assets. That is what I do. So not that some others will not do. I've seen other reports, a business advisory report that uses other item as a base figure, but use this for your exam. And again, Anthony, case study exam, they will not tell you what to use. Oh, anyway, since we are just starting, today is the first day. Nobody will tell you what to use. The examiner will just give you general requirements. So one of the key cornerstone in case study exam is judgment, your ability to apply your judgment, to know what to use. So, which is why I was saying, all of you, some people will do vertical analysis, some people will do horizontal analysis. No, the examiner will not tell you using horizontal analysis. No. So, which is why we just want to expose you to everything, discuss it without finding a way to discuss it with you without cramming, trying to understand it, then be able to then apply it in the exam. So, anyone that wants to, is there anything we haven't seen in this vertical analysis? Because at least from what vertical analysis can help us do is, I mean, you are going to spot the pressure areas. I was able to see clearly that this company is heavily invested in capital expenditure. So I just need to be sure that it translates to revenue. And I can see clearly that the liabilities now is increasing. But even, yes, they are not so financially leveraged because equity is much more. I mean, their equity is 50% of their assets in 2023. It's 40% of their assets in 2024. But it's declining. I can see that it's declining. While debt is increasing, that means they are now shifting. There's a capital structure shift from equity-based to liability-based. That means financial risk is increasing and there is a solvency risk as well because they will now start paying higher interest. So they need to find a way to ensure that they maintain that mix, the existing mix in such a way that liability is not more than equity. And they need to ensure that this huge investment in capital expenditure translates to cash flow and revenue. So don't worry, all these I'm saying, yes, I have some of them in your notes that I will share with you, but we are going to write it down, and which you also have to do yourself before you enter the exam. We would write it down together here and do reports. Okay, let's take comments from anyone that is interested in talking.
So I wanted to ask, like you said earlier, that um that the equity that the company is not really geared yet because equity is 50% of their total assets. But I was now like I was confused in the sense that if equity is 50% of total asset, does that mean that like the other 50 is in the debt? Or so like this 2024 now that is 40%, the other 60 is in the debt, if you understand what I'm saying. Or the other 50 is in the other line items here, like non-current liability, current liability, and the rest.
Yes, that's a very good question. And we can see it clearly here that the other item, while the non-current is 20%, the current is taking 30. So that's where the other 50% is actually coming from. But I'm not bothered about current liabilities. I'm not bothered about it because looking at my current assets it's conveniently over and above my current, so that matches one another. The one that creates financial risk is non-current, not current, because current liability are things like trade payables, maybe sub-to bank overdraft, maybe tax and all that. But non-current is the actual borrowings. That's when you take out loans, debentures, preference shares, and all that. So I'm not really bothered about that. Yes. Sure you get it.
Yes, sir. Yes, sir.
Yeah,
Okay,
good one.
hello, sir. Yeah.
Yeah,
Sorry, sir.
Anthony.
I have a question. I think, like I said, maybe I'm just going too far, going close to the exam instead of maybe taking it step by step, which luckily you say you're going to handle for, which is fine. But now that, for example, now when you're giving this financial statement for you to analyze,
Okay.
of course, they won't tell you what to do. It is for
Yeah.
you to use your sense of judgment. Now,
Yes.
in exam situation, definitely that 4 hours, like they say, is like 2 hours. So speed is of the essence, for example. Now, is it proper that we do the vertical and the horizontal? Or probably if you do the horizontal, that's fine, and make your analysis, your judgment. Or is it a must that you must compute the vertical and the horizontal? I just want to know if one of them can go, or is standard that you have to do both of them, even though you're not
Only
told
one
which
of
one to
them.
do.
Only
Okay.
one of them. Just do one of them. So hopefully
So,
by the time we're looking at it, hopefully I'll be able to speak to at what point are you going to use the order? At what point
okay.
are you going to use the order? So either one is fine. Don't ever do the two.
Okay, sir.
Never, ever, ever, ever.
That's clear for me. Thank you, sir.
You're welcome. Any other comments, please? Okay. Now, I'm sure that you are clear with vertical analysis and horizontal analysis. Now, another one is ratio
Hello,
analysis.
sir. Sorry, sir. Hello, sir. Sorry, sir. My own
Yes,
observation. Hello,
yes,
sir.
sir.
I have one
Yes, sir.
observation. When we are doing the sales, profit, gross profit, profit after tax, all those ones, our percentage analysis was based on percentage of against sales. It was against sales. Percentage change against sales. Everything is true is against sales. But now in financial statement, all these current assets, liability, all of them they are against total assets. I just want to know, is it a statutory that they should be like that? That it must be this one must be against total assets, the other one must be against sales.
Yes, is actually a standard. It's actually a standard. I highly recommend that that's how you'd approach it in the exam. So, not that we cannot use other item as a base figure, but it makes more analytical sense to use revenue as a base figure for income statement items because it's easily interpreted, and also to use total asset as a base figure for statement of financial position items because it's easily interpreted. So use that for your exams.
Okay, thank you, sir. Noted.
You're welcome. Now, another analytical tool is ratio analysis, and there are quite a number of them, from profitability ratios to liquidity ratios to solvency or leverage ratios to efficiency ratios to market or investors ratios. So this one mostly you likely always do. It can work along with the above, either horizontal or vertical. You'd be able to, this one gives more, it gives more information than horizontal and vertical. It gives more information than those ones because this one, unlike vertical, that only use sales as base figure for income statement items, this one goes beyond that. It looks at related items in income statements and makes sense out of them. So, or even vertical analysis that focuses on total assets in the balance sheet as a base figure. This one goes much more. It goes much further than that. It's more flexible for you, right? So even, yes, vertical analysis speaks to some areas, but this one speaks to more areas. It speaks to every aspect of the business. So starting with profitability, the very first one is gross profit margin, which is your gross profit as a percentage of your sales. And this really shows whatever you get here will tell you about the pricing of that company. Because when a company is having a high gross profit margin, it might be as a result of because its selling price are very high, and it could also be as a result because its purchase price or is low, is able to buy or purchase those items at a low price. And it depends on the data. See, the direction of this analysis here will depend on the data given to us. If they give us information of a company selling at the standard price the industry is selling, but its gross profit margin is now higher than that of industry, then that means that what is giving it an edge is cost control and efficiency. It shows that the company is managing its costs very well, especially the input cost. So if it is a company that is a market leader and is the one that is deciding prices in the industry and is able to charge higher prices and is having higher gross profit margin than industry, then you can see where that is coming from for him. It's because he's able to sell at an higher price. So given a cost of a sales of 200 million and cost of sales of 140, having a gross profit of 60 million, this shows that this company has a gross profit margin of 30%, which is the gross profit of 60 million over the 200 million. And that's 30% gross profit margin. So it means that on every sales, we are making 30 kobo. We are making 30%. And that will be available to cover other expenses. So, and it may mean that if our gross profit margin is increasing, like I mentioned, it means that our cost is decreasing or our pricing is increasing. If it's not declining, if your gross profit margin is declining, it might mean that your cost is increasing or your selling price is reducing. Probably maybe you are doing a lot of discounts, marketing and promotion just to get more users or customers. Another one is your operating profit margin. Operating profit is synonymous to profit before interest and tax. And this measures the profits you get, because this is the profit after you have deducted your operating expenses. That's why they call it operating profit. So when you are having an increasing operating profit margin, it shows your operational efficiency and your ability to manage your operating expenses, your administrative activities. So this goes beyond just the direct cost, but also considers your indirect expenses as well, your operating expenses also. So we have an earnings before interest and tax of 36 million and a sales of 200 million, meaning this company is making an operating profit margin of 18%. So majorly, an increasing operating profit margin will show us that this company is able to operate efficiently and manage its costs, especially admin, selling, and distribution. Admin, selling, and distribution is able to manage it very well. So where operating profit margin is declining, but your gross profit margin is stable, again, the problem is in the admin, selling, and distribution. So I'm emphasizing this because when you're analyzing, when you're making recommendations, you need to understand where the problem is coming from, what is causing the decline or the improvement. So, because you need to speak to that. It's not just about saying it that, okay, you need to let us know why is it increasing, why is it decreasing. For gross profit margin, I've told you is in the costs of goods and also the selling price. Here is in the admin, selling, and distribution. Your net profit after tax is like profit for the year. So is the amount of profit you make on every sales. And this one speaks to all other expenses, because you're talking about your profit after all expenses, including finance costs and tax. And is this one we will then be able to know that, okay, because this is where our shareholders will be looking at, because this is where they can come in after we have paid everybody. They are looking at, okay, 12%. They are doing 12% of sales as profits. Not bad. So, of course, this is just showing you what they mean and the formulas. But ultimately, when you're analyzing, is that you're analyzing with prior year or with industry. Another one is return on assets, which is your profit for the year over total assets. And this measures efficiency. How efficiently are you able to use your assets to generate profits? So a company that is doing 8% return on assets shows that is able to make 8% profit from its assets. So if it's declining, it shows that it is underutilizing its assets. So return on assets shows asset efficiency. While returns on equity shows what we are giving to our shareholders, what our shareholders will get. So is the return our profits, proportion of profits, or the expected returns to shareholders. So a company that is doing 20% means that we are going to give a return of 20% to our shareholders. That's returns on equity. Is the profit for the year over shareholders' equity. And finally is returns on capital employed, which is our operating profits divided by all the capital. And this capital employed is mostly equity plus non-current liabilities. So we are looking at the return to all providers of capital. And that is why the underlying profits is not profit for the year like we did up there, but rather we consider the profit before we paid interest and tax, because the bottom here of the denominator is speaking to equity and non-current liabilities, all our sources of finance. So a company that is doing 20% might be good, it might be bad, depending on industry and the weighted average cost of capital in the industry as well. That's returns on capital employed. If they give us an information like this, and I have a gross profit margin of 30%, I have an earnings before interest and tax or operating profit margin of 18%. And I hope you know that my gross profit margin is gross profits over sales. And I've gotten my gross profit as 20 minus 140, which is sales minus cost of sales. That gives me this 60. And earnings before interest and tax, which is my gross profit minus operating expenses of 24, this 24, give me 36. And 36 over sales is 180%. My net profit or my profit for the year is my EBIT, my profit before interest and tax, minus the interest of 6, minus the tax of 6. I get 24. As a percentage of my sales gives me 12%. My return on assets is my profit for the year of 24, this 24 year, divided by my total assets of 300. They give us 300 here. That's 8%. And my returns on equity, which is my profit for the year, which I got as 24, divided by shareholders' equity of 120, which is this 120. And my returns on capital employed, which is my earnings before interest and tax of 36, this 36 here, divided by 180, which is my equity plus non-current liabilities, which is 180. And how did I get that? I did my 120, and they gave us here as 380, or even if they didn't give me this, since my total asset is 300 and my equity is 120, so the balancing figure of 180 will have been my capital employed, because it's equity plus non-current liabilities. Equity plus non-current liability. But since they gave me my 180 directly, so no stress. And that's 20%. Now we have computed this ratio. Now you will need to speak to it in our reports, because we are going to compute all of this in the appendix, but we need to speak to them. And if I want to speak to this at a very high level, I can say that this company is making a gross profit margin of 30%. I would have been comparing it to industry or previous year, but I don't have that information here, but I can just do the comparison among the ratios. But I can see a decline in the profit as a percentage of sales, my operating profit as a percentage of sales. Now it is now 18%, showing the increasing level of operating expenses. And there was a further reduction in the profit for the year as a percentage of sales to 12%, showing the increasing finance cost as well. My return on assets is 8%, return on equity is 20%, return on capital employed is 20%. This might be okay, provided they are not lower than the weighted average cost of capital. So the problem around this for this company is, depending on what the industry is saying, I think they can do better earnings before interest and tax on your sales as a percentage of sales, as well as the profit as a percentage of sales by reducing cost and increasing revenue. So if you look at the commentary here, you see that this company having a 30% gross profit margin shows that its pricing and cost control is good. And the operating profit margin of 18%, here we are assuming that overheads are well managed. And if the industry average is given, we'll be able to compare this net profit margin. And return on assets might be modest if you can compare it with the previous year. Returns on equity of 20% shows that if it is higher than cost of equity, or if it is higher than cost of borrowing, it might attract shareholders. And also, this return on capital employed, if greater than weighted average cost of capital, might also attract investors to the company. So that's that for the profitability ratios. Do we have any comments or observations?
Hello, sir.
Yes, Sir Christopher.
Okay, sir. And one of my major challenge in this ratio analysis is the fact that when you are computing for it and you have a certain percentage, the problem I usually have is I don't know if it is lower here or if it is higher there. I want to know that is there like a specific benchmark for percentage for you to know that okay, I've calculated this. Since this is lower than since this is lower, it is okay. If it is higher here, it is okay. I want to I don't know. I don't know if you get me.
Yes, I do. I get you very well.
Okay.
So there are some ratios that has benchmark, but don't use them in the exam for your analysis. Don't, because you are providing advisory services. Those benchmark, who created them and all of that. So everybody we shall saw the benchmark. What's the basis for it? So what you should rely on is comparison with previous year. Comparison with previous year and industry. That is what you should rely on. Even though the one that has profitability does not have any benchmark. So like the gross profit margin now, if it is increasing, it's good. So you can speak to that, okay, they are charging good selling price or they are reducing their costs. And if it is decreasing, you say it's bad. The same thing for this one. If it is increasing, yeah, you see, I mean, I'm talking about year on year. That means you would probably do 2 years ratio. Or if they give you the industry average, then you can be comparing it with that. Then this one, you can be speaking to their operating expenses and operating efficiency. The same thing for profit for the year. On your sales, this one, you'll be speaking to finance costs and taxes, depending on the direction. But of course, the higher, the better for all this. While for this one, in terms of asset utilization, comparison to previous year and industry average is also the standard. This one, then you can be comparing it to borrowing costs or cost of equity, as the case may be, if they give you. So we can use that as a benchmark for this. Because if the return you are giving to your shareholders is higher than the return they will get elsewhere, or if they go and invest that money in the money market, you know that if I invest in your company now, you are giving me 20%, But I know that if I go and put say that same money in fixed deposit for 1 year, I'll get 30%. Why will I now give you my money now? I'll go and put it in fixed deposits. I'll go and put it in money market so that I can get 30%. So when you're looking at the return you give to your shareholders, and also the return you give to all providers of capital, you are going to be looking at it with respect to the cost of capital. What rate are they giving them on the money market? That would inform us in making our decision. So those are relevant benchmarks. But in the exam, you most likely will be comparing it with previous year and industry average. That's the best. While for specific ones, you can then have like a benchmark or something like that.
Okay,
Any
thank
other
you.
comment? Yeah.
Yeah, so I have a question on that return on asset.
Okay.
So when I see that return on asset, I see assets as land and building, furniture and fitting. How does is it that if because I'm trying to see how profit relates to that. You understand what I'm saying? Because I'm just looking for the interpretation behind it. That's all. Because I don't see how they relate to profit.
Yes, I get your points. So, in fact, according to IAS 16, it's not all assets. In fact, the way IAS 16 defined PPE said it's an item that is held for use in the production or supply of goods or services, rental to others, and for administrative purposes. So the ones that make money, like your plants and equipment and all that, those ones are the ones you hold for production of goods or services. Those ones you can see they make money directly. Those other ones that are held for administrative purposes, like your furniture and fittings, your air conditioners, your laptop, and all of that. Those ones, they might not make money directly, but without them, we cannot function. Without them, the company, the operations cannot be smooth. So indirectly, they are adding value. Indirectly, they generate income. Because without them, we cannot make money. So they also contribute to the top line, revenue and profits at the end of the day. So they do also contribute. So when you're doing return on assets, you do your sales over your total assets, both current and non-current, because they all contribute towards that sales.
I thought it was operating, um, sorry,
Yes, yes,
ROE.
yes. Yes, it's your profit for the year,
Okay,
not your sales.
thank you, sir.
Yeah. Any other questions? Okay, let's take one more category before we'll close. There is liquidity ratios. And what this does for us is that it shows the ability of the company to meet their short-term obligations. So in the exam, of course, we need to calculate, interpret, and conclude and make recommendations, right? So what are the key liquidity ratios? There's a current ratio, which is, do you have available short-term assets to meet your short-term liabilities? So usually this one, they use a standard of 2:1 for this, but like I mentioned, the acceptable level depends on industry and business model. Because a company that is into service, they might not have high level of current assets because they don't have inventory. But like a supermarket that has huge inventory, you see them having high current ratio. So having a one for all benchmark for these ratios will be misleading. So it depends really. So, but that's current ratio. The higher, the better. It shows that your assets, your short-term assets can cover your liabilities. While quick ratio goes a step further by considering liquid assets alone after removing assets that are not easily convertible to cash, like your inventories. So this focuses more on any other liquid assets by removing inventory. So by the time you compare that to your current liabilities, this one is also a benchmark of 1:1, but again, the higher the better. That's how we look at it. The higher the better. And what's the industry doing? The higher the better for us. When you have sufficient liquid assets to cover your liabilities. There's also current or cash ratio. I mean, this is very conservative because this one focuses on the cash or short-term marketable securities, like your fixed deposit and all that, the cash you have. If liability come today, do you have cash to give to them and say, yeah, take your money? Do you have an immediate cash cover for current liabilities? That is what cash ratio looks like. So you'll be looking at figures on the similar financial position to pick up all of on these items. The cash equivalent, and short-term marketable securities. There is working capital, which is absolute working capital, usually current asset minus current liabilities. We expect at every point in time that you have a positive working capital. And there is the operating cash flow to current liabilities. This one, instead of using the raw cash in the statement of financial position, why not just look at the cash that you generated from your operations? And you would usually get this from the cash flow statement, which is the net cash flows from operating activities. And there is one called cash burn ratio, or days of liquidity or defensive interval. This one wants to look at the number of days before we run into liquidity problem. Or how many days do we have to operate without additional cash inflow? So by the time you look at the money you have and the money you're expecting from receivables, including the money you have in the money market, you divide that by your daily cash outflows. It gives you idea of how many days you have before you would need additional cash flow, or how many days can you function or operate without additional cash flow. This is particularly important for startups. So these are the liquidity ratios.
So,
yes, Amitri, go ahead, please.
what part of the financial statement will you get that daily cash flow from?
They will give you in additional data. Because you will not see it on the face of the financials. So they will give you, and if they don't give you, that means you won't be able to compute this.
Okay.
So they gave us these examples. I looked at my current ratio. It's giving me 1.5, which is my current asset of 7.5, divided by my current liabilities of 5,000. When I take out my inventory for my current assets, inventory was 3,000. I take it out for my current assets, divide it by my current liabilities. I'm getting 0.9. My cash ratio, using just my cash, because that's the only thing I have, divided by current liabilities is 0.3. My working capital, which is current asset minus current liabilities, that is 75 minus 35 minus 5,000, I'm getting 25. An operating cash flow coverage, which is my net cash from operating activities of 1.2, divided by my current liabilities of 5,000. And this will be gotten from cash flow statement. So it's giving me 0.24. So even though there is nothing to compare it with, I can see that I have 1.5. If it has increased from prior year, that's good. It's an improvement. At least we can still cover our liabilities by more than 1 times. But by the time I take out inventory for my assets, I saw that we can no longer cover our liabilities, which means that this company is depending on inventory, which is a business risk for him. It can even be a liquidity risk. What if they are unable to sell? That means they won't be able to settle their liabilities. And the available cash to settle liabilities is just 0.3, very small. It then depends on the industry average anyway, what the industry is doing overall. It has a positive working capital, not bad. And my operating cash flow coverage is just 0.4. Now, for my interpretation here, the 1.5 years is moderate, but if it's declining, then that means that one is not good. If it's increasing, it's fine. Again, I said that this, by the time we remove inventory, our quick ratio went to 0.9, which shows that this company cannot meet liabilities without relying on inventory realization. This is a risk, especially if inventory is slow moving or obsolete. If you're unable to sell, that means we cannot settle our liabilities. It's a huge risk for us. Cash ratio of 0.3 is low. That means only 30% of our liabilities is covered by cash. That means we don't have money. We're only depending on if we sell receivables, if we sell inventory, or if we collect money from receivables, or even refinancing if possible. Operating cash flow, of course, expectedly, just 24%. So this company has a liquidity strain or liquidity stress. Their liquidity is strained because they are relying on collection. So they should prioritize receivable collection, inventory reduction, and try to negotiate extended supplier terms with their suppliers. And that's what this ratio is speaking to. And we have some other guides that I actually gave you here from some adjustments we'll still make later. So the benchmark somebody was asking, I gave you some benchmark that are applicable, but when we start solving past questions, you will see that I would majorly focus more on industry and prior year comparison. And I gave you the common causes of poor liquidity. from when you have 2 lakhs credit terms where your receivable is ballooning and you are not collecting it, or you have a lot of stocks, your inventory is tied up, or you have borrowings that are maturing that you need to settle, or you're not generating money, your margin is very low, or your dividend policy is draining your cash, you're paying so much dividend, or there's a one-off tax payment you need to make, or CapEx, you're financing your capital expenditure from your operations cash flows. These are sources of poor liquidity. And what we would recommend is try to collect those receivables. Try to reduce your inventory. Negotiate with your suppliers. Convert short-term debt to medium or long-term so that maturing debt can be pushed forward, probably through refinancing or trying to borrow only medium and long-term debts. And you need to build contingency funds and reduce discretionary cash outflows until liquidity recovers. And they also look at some mistakes that students make in the exam by just looking at ratio in isolation and not comparing it with cash flow, or ignoring the quality of your current assets, depending on the data given to you. If you have receivables that will take a long time to become due, that means you cannot rely on that to judge on liquidity. Or if there are one-off items or seasonal items, that has to be adjusted. You cannot authorize it to distort your decision making. Or if you have committed facility or pledged assets, where you have pledged some of your assets as collateral, those needs to be adjusted when making our analysis. So for financial statement analysis, we have discussed quite a number of them today. I'll continue with you from the next class. Hopefully, in the next class, we'll go far on financial data analysis as well as report writing. So that upper week, we'll start looking at how to write those actual reports. If you don't have any questions for now, I guess we can see in our next class. All right, thank you very much. Have a wonderful day. Bye.
Bye-bye, sir.